faithfully delivering value, interpreting great books worldwide. Hello, this is Sally's Book Talk. Today's book for you is The Epic of Buffett and Munger, subtitled Replicable Value Investing. The stock god Buffett is idolized by many investors, and his methods are classic case studies in value investing. But did you know? Buffett's average annual return is about 20%. That's not particularly high for average investors, even lower than some star fund managers' returns in China. So why is Buffett called the stock god? Because stock markets fluctuate wildly. Temporary gains are easy. Sustained profitability is the real challenge. Buffett achieved this. Let's calculate. With 20% annual compounded returns, 10 years yield 519%. 20 years yield 3,734%.
Meaning 100,000 yuan becomes 23.73 million yuan in 30 years.
Over 20 million seems unreachable for many, yet his starting capital was just 100,000 yuan. That's compounding power. Selecting right investments and compounding were Buffett's keys to success, but his journey wasn't smooth. The Epic of Buffett and Munger details his investment path, revealing the stock god isn't infallible. His era, experiences, and key encounters were crucial. Charlie Munger stands out. A Harvard Law graduate, he started as a lawyer. Later, real estate investments earned him his first $1 million effortlessly. But he stayed low profile, advising Buffett behind the scenes. Buffett once said, "Charlie pushed me to evolve from ape to human in investing. I'd be far poorer without him." The title, The Epic of Buffett and Munger, reflects their mutually transformative partnership. Author Tang Chao is a renowned finance writer. Investing since 1995, he gained fame with hand-in-hand guide to reading financial reports. The Epic of Buffett and Munger is one of Tang Chao's representative works, hailed by investor Yang Tianan as a serious, historically valuable financial history book. One that's excellent both inside and out, elegant and refined. This book is written in the traditional Chinese chapter-style novel format, depicting value investment across 42 chapters. It covers the evolutionary journey from scratch over nearly a century of American financial history, a rare work in the finance field that combines professionalism and readability. And next, I'll explain through 3 parts. Part 1 of the book focuses on value speculation, represented by cigar butt investing. Part 2 centers on value investing with the core idea of accompanying high-quality enterprises in their growth. Part 3 involves index funds that profit by investing in the entire market. First up, Part 1 focuses on value speculation, represented by cigar butt investing. In his early investment career, Buffett was influenced by his teacher Benjamin Graham and primarily used the cigar butt investing method. So, what is a cigar butt stock? It refers to stocks where the residual value is higher than the market value. They're like cigar butts, mostly consumed, but you can still take one last puff. Investing in cigar butt stocks follows similar logic. Suppose a company is poorly managed, with revenue, growth, potential, competitiveness, all indicating it's not worth buying, but it has many assets on its books. As long as this residual value is higher than its current market price, it still has investment value. Cigar butt investing has 2 main methods. The first is called the controlling type. Cigar butt investing means buying stocks to become a major shareholder and gain control. For example, in the case of Northern Pipeline Company, Graham continuously bought its stocks, gained a voice in the board, influenced decisions, liquidated company assets, and earned substantial profits.
Buffett also used controlling cigar butt investing. Specific cases will be covered later.
The second is called low valuation cigar butt investing, meaning buying undervalued cigar butt companies and selling after they rise to profit.
Schloss did it this way. The reason we mention Schloss specifically is that he's known in the investment world as the purest heir to the Graham system and was once an employee of Graham Newman Corporation alongside Buffett. Notably, unlike controlling cigar butt investors, Low valuation cigar butt investors aim to profit by buying low and selling high, since controlling and influencing the board is too challenging. However, low valuation cigar butt investors welcome controlling cigar butt investors buying their stocks, because the intervention of controlling cigar butt investing helps push the company to realize asset value. So, Schloss's low valuation cigar butt investing still requires support from Graham's controlling cigar butt investing. Hearing this, you might think cigar butt investing is a surefire profitable business. But is that really true? The author provides us with 3 representative cases. The first is the case of Sanborn Map Company. This company's main business was providing detailed maps of U.S. cities to insurance companies, allowing them to calculate fire probabilities based on building structures, fire layouts, etc., to design insurance products. However, in the 1950s, new probabilistic statistical methods emerged in the market, causing demand for Sanborn's maps to plummet, operations to struggle, and many investors to avoid it. But Buffett discovered that although the company's core business was declining, it had invested substantial surplus funds when capital was abundant earlier.
And by the end of 1958, the value of these investments had grown to $5.67 million.
Meanwhile, Sanborn's stock market value was $4.73 million, indicating the stock price was below the low valuation range. Additionally, the company had low marginal costs, meaning producing one more map cost very little, so it could still generate small annual profits. These 2 points met the criteria for being a cigar butt stock. The company was in decline but still had residual value to harvest. After identifying Sanborn as a cigar butt stock, Buffett's next step was to realize its value. Realizing value meant monetizing this investment. Any operational decision by a public company requires board voting approval. Therefore, for Buffett to push the company to realize value, like spinning off lucrative divisions, he needed to convince shareholders holding sufficient stock to join his camp and influence board decisions. Therefore, he purchased Sanborn stocks himself while allying with 2 major shareholders, ultimately succeeding in pushing the company to spin off its core map and investment businesses, profiting from it. The second case involves Dempster Mill Manufacturing Company. This company mainly profited from producing windmills, water pumps, and other farm tools. Dempster windmills were once ubiquitous across rural America, but with the advent of electric grids and pumps, electricity better replaced wind and water power in agriculture, leading Dempster inevitably into decline. Similar to Sanborn, Dempster's valuation exceeded its market value. Buffett valued this company at $2.14 million. The company held securities worth approximately $2.03 million, yet its market value was only about $1.82 million when Buffett bought in. He acquired 71.7% of the shares, meaning he bought the company plus securities worth $1.45 million for under $1.3 million, fulfilling cigar butt criteria.
The company was declining, yet still profitable.
And this time, it seemed a guaranteed profitable venture. Unlike the first case, Buffett gained full control here without needing shareholder alliances to sway board decisions, because he saw clear improvement potential in its core business. For instance, he found Dempster priced after sales, spare parts, identically to new equipment parts. This strategy failed to leverage existing customers' dependency on spare parts, reducing profitability.
Thus, he proposed raising after-sales parts prices while liquidating inventory, reducing capital recovery time, and investing to resolve Dempster's operational crisis.
But reality struck. Buffett struggled to find a suitable manager to implement his vision. Then, Buffett's partner Munger recommended an ideal candidate, a troubled business turnaround expert. Thanks to Butler's efforts, Dempster revived, valuations soaring from $35.06 to $65 per share. However, things weren't that simple. Though Buffett gained substantial profits, it became a public enemy because Dempster carried out massive layoffs during its asset and business optimization, sparking widespread anger. Buffett became the hated heartless capitalist overnight. If the Dempster case brought Buffett moral condemnation, the next case caused tangible economic losses. Now let's examine the third case together. The Berkshire Hathaway investment case. This company resulted from merging Berkshire and Hathaway. Both were textile industry giants. Merged, they became a behemoth with 14 factories, over 12,000 workers, and annual sales of $112 million. After the merger, Hathaway's former president, Seabury Stanton, continued as CEO, focusing on boosting capacity, equipment, and technology to expand competitive advantage. Yet the company lost money for 9 consecutive years, with its stock price plummeting. At this point, Berkshire Hathaway met cigar butt criteria. Net working capital valuation was $12.35 per share. Buffett planned to buy Berkshire Hathaway stock at $7.05 per share.
Initially, a modest investment meant for quick profit turned sour after a pricing dispute with CEO Seabury. Instead of selling, Buffett bought more shares to oust him.
Ultimately, investing in an unfamiliar business proved disastrous. Buffett couldn't salvage it and had to liquidate assets cheaply, causing massive losses. These cases show cigar butt investing seems foolproof, but unexpected factors introduce risk and can cause losses. In Dempster, Buffett gained substantial profits but earned notoriety.
In Berkshire Hathaway, his irrational actions and textile industry overconfidence directly caused huge losses, showing investor ethics and judgment matter.
Investment mindset is crucial. Maintain calm and rationality. Never invest in unfamiliar industries. So, can ordinary people use the cigar butt investing method? Well, the author sees limited practical value in cigar butt investing for ordinary folks. It's hard to replicate since it requires 3 conditions. First, finding bargain stocks priced below 2/3 of net working assets. And quote, second, having methods to realize asset value. Finally, gaining some control over board decisions. For average investors, the first condition's doable, but the latter 2, nearly impossible. Now, back to Buffett. After moral backlash and stumbling in unfamiliar territory, he grew tired of cigar butt investing and pivoted to value investing. Next up, Part 2, Value Investing Centered on Growing Alongside Quality Enterprises. Buffett's shift to true value investing owes much to his close friend and partner, Charlie Munger. Munger's investment prowess rivals Buffett's. In fact, he embraced value investing before Buffett did. Munger's philosophy aligns with Philip Fisher, father of growth stocks, both advocating investing in great companies, not just cheap ones. Why? Such companies dominate their core business. Think proprietary tech, brand power, giving them competitive edges. Plus, their stellar management teams steer them toward prosperity and weather crises smoothly. Long-term, investing in excellence delivers superior returns. Realizing value means monetizing the investment. Any major decision by a public company requires board approval. So, to push value realization, like spinning off lucrative divisions, Buffett needed shareholders to back him and sway the board. Thus, he bought Sanborn stock himself while partnering with 2 major shareholders, forcing a spin-off of MAP and investment divisions to profit. Second case, Dempster Mill Manufacturing Company. This firm mainly profited from farm tools like windmills and water pumps. Once, Dempster windmills dotted rural America, but with electric grids and pumps replacing wind and water power, decline became inevitable. Similar to the Sanborn case, Dempster's valuation also exceeded its market value. Buffett valued this company at $2.14 million. The company held securities worth about $2.03 million, yet its market value was only around $1.82 million when Buffett bought in. He acquired 71.7% of the shares, meaning he bought the company plus securities worth $1.45 million for under $1.3 million, fulfilling cigar butt criteria.
The company was declining, yet still profitable.
And this time, it seemed a guaranteed profitable venture.
Unlike the first case, Buffett gained full control here without needing shareholder alliances to sway board decisions.
Because he saw clear improvement potential in its core business. For instance, he found Dempster priced after sales spare parts identically to new equipment parts. This strategy failed to leverage existing customers' dependency on spare parts, reducing profitability. Thus, he proposed raising after-sales parts prices while liquidating inventory, reducing capital recovery time, and investing to resolve Dempster's crisis.
But reality struck. Buffett struggled to find a manager to implement his vision.
Then, his partner Munger recommended an ideal candidate, a troubled business turnaround expert.
Thanks to Butler's efforts, Dempster revived, valuation soaring from $35.06 to $65 per share.
However, things weren't that simple. Though Buffett gained substantial profits, he became a public enemy because Dempster carried out massive layoffs during optimization, sparking widespread anger.
Buffett became the hated, heartless capitalist overnight.
If the Dempster case brought moral condemnation, the next caused tangible economic losses. Now let's examine the third case together. The Berkshire Hathaway investment, formed by merging Berkshire and Hathaway. Both were textile giants. Merged, they became an industry behemoth with 14 factories, over 12,000 workers, and $112 million annual sales. And after the merger, Seabury Stanton, Hathaway's former president, continued as CEO, focusing on boosting production capacity, equipment, and technology to expand competitive advantage. Yet, the company lost money for 9 straight years, with its stock price plummeting. At this point, Berkshire Hathaway met cigar butt criteria. Net working assets valued it at $12.35 per share. Buffett planned to buy Berkshire stock at $7.50 per share. Initially a modest investment for quick profit turned sour after a dispute with CEO Seabury over pricing. Instead of selling, Buffett bought more shares to oust him. Ultimately, investing blindly in an unfamiliar business proved disastrous. He couldn't salvage it and liquidated assets cheaply, causing massive losses. These cases show cigar butt investing seems foolproof, but unexpected risks can cause losses. In Dempster, Buffett gained profits but earned notoriety.
In Berkshire Hathaway, his irrational actions and textile industry overconfidence caused huge losses, proving investor ethics and judgment matter.
Investment mindset is crucial. Stay calm and rational. Never dive into unfamiliar industries. So, can ordinary people use cigar butt investing? The author sees limited practical value. It's hard to replicate. It requires 3 conditions. First, finding bargain stocks priced below 2/3 of net working assets. Second, having methods to realize asset value. Finally, gaining some control over board decisions. For average investors, the first condition's achievable, but the latter 2, nearly impossible. Back to Buffett. After moral backlash and costly missteps, he grew tired of cigar butt investing and pivoted to value investing. And next, I'll explain part 2. Value investing is centered on growing alongside quality enterprises. Buffett's true shift to value investing owes much to his close friend and partner Charlie Munger. And Munger's investment prowess rivals Buffett's. He embraced value investing before Buffett did. Munger's philosophy aligns with Philip Fisher, father of growth stocks, both advocating investing in great companies, not cheap ones. Why? Such companies dominate their core business with competitive edges like proprietary tech or brand power. Plus, their stellar management teams steer them toward prosperity and weather crises smoothly. Long-term, investing in excellence delivers superior returns. So, how do we find these excellent companies? Additionally, Fidelity Fund was inherently a mutual fund with more conservative investment style. You can approximate mutual funds as China's public funds, openly raising capital from the market. These funds are publicly accessible with low thresholds, opposite to high-threshold private equity or hedge funds.
Research shows investors' risk tolerance correlates with personal and family wealth. Thus, average investors have lower risk tolerance than wealthy ones, making mutual funds naturally more conservative than hedge funds. The fund managed by Jerry Tsai was such a mutual fund. During the Great Depression, declining wealth made investment styles more conservative. Ordinary fund managers and investors sought stable, capital-preserving investments. They deemed stock markets too risky, prioritizing dividends, but Tsai held the opposite view.
He believed America's strong economic foundation promised huge growth, especially in manufacturing and tech.
Thus, the depression was temporary. Markets would rebound soon. Overemphasizing low risk would only reduce returns and miss opportunities.
So he invested raised capital into high-growth potential stocks.
Post-recovery, these stocks surged significantly, delivering massive gains that quickly made him famous. A wave of Jerry Tsai followers flooded the market. Men, women, old and young bought his funds while investors chased stocks he favored. Later, he founded his own fund, Manhattan Fund, but unexpectedly began a downward spiral with continuously declining performance. Tsai had to sell the fund company to CN Financial, continuing fund management while overseeing CN's strategic acquisitions. Ultimately, he resigned amid sustained losses, leaving investors and CNA shareholders with a disastrous mess. In contrast, Buffett would protect investors during failures, proving a fund manager's integrity matters immensely. Here we glimpse the art of fund selection. Funds using strategies to outperform markets are called active funds. Tsai managed active funds, the opposite being index funds. Such passive funds track market indices for average returns, never seeking extra gains. From Tsai's case, we uncover fund selection insights.
First, past performance is not equal to future results. Tsai shone early but failed repeatedly later. Analyzing factors behind a manager's performance is called performance attribution.
Fund manager attribution is tricky. Distinguishing luck from skill is notoriously difficult. As Buffett's career shows, success needs luck and skill. Opportunity is vital. Many managers prosper from bull market luck alone. The rare skilled ones adjust tactics during downturns, pick winning sectors, and deliver sustained returns. But they're exceedingly scarce. Thus, when selecting funds, don't just eye past performance, focus critically on bear market results. That's why we avoid managers with short track records. Beyond performance and tenure, assess ability, though often only through education and career history. For example, if someone worked as an industry researcher before becoming a fund manager, their investment fundamentals would naturally be stronger. Additionally, if a fund manager's investment style drifts, deviating from the fund's stated strategy, it may expose investors to greater risks or even losses. The fund company's reliability also significantly impacts performance. For instance, reliable firms replace underperforming managers promptly or provide psychological support if the strategy is sound, ensuring normal performance. They also assess if holdings are appropriate. Investing primarily involves judging whether holdings have value, serving as initial screening. Lastly, large funds often underperform. Huge assets complicate trading and may leave capital uninvested. Even Buffett struggles with where to invest when managing massive funds. Clearly, active funds performance involves uncontrollable factors. Tsai's investors never anticipated his downfall initially. Buffett champions index funds precisely for their stability, rarely swinging wildly due to manager performance. How confident is Buffett in index funds? The book notes, Buffett set $1 million bet. Participating managers could pick greater than or equal to 5 funds to form a portfolio. We call such portfolio-based products fund of funds, FOF, investing primarily in other funds, not stocks or bonds. Buffett bet these FOFs couldn't beat the S&P 500 index fund over 10 years, the most common U.S. stock index. This broad market index selects the 500 largest U.S. public companies. An S&P 500 index fund tracks this index, closely mirroring its performance. Simply put, index fund returns mirror market index returns, what we call market performance.
So, what was the bet's outcome?
As you might guess,
Buffett won. Not one FOF outperformed the index fund. Now, what funds did these FOFs actually hold? They held over 200 funds, representing 200 Wall Street elites and their research team's expertise. At the bet's conclusion, Buffett perfectly summarized active versus index funds. He said only a tiny fraction can beat the S&P 500. In his lifetime, he met just 10 such people. Others briefly outperform indices, but ultimately fail. Buffett also explained why fund managers lag indices. He divided investors into active and passive types. Active investors share similar concepts and goals, beating index returns. Relative to active investors, others are passive investors. Among active investors, some outperform indices. Some match indices, others underperform. But active investing has extra costs. Frequent trading generates commissions and taxes, plus fees for chasing higher returns. For example, investing in active funds means higher management fees paid to managers. If actively self-investing, they pay for professional tools, databases, and consultations. After deducting these costs, few active investors truly beat indices.
Buffett advises ordinary investors choose index funds.
This concludes Buffett's investment evolution. Success born of wisdom, learned failures, and Munger's pivotal support. From cigar butt investing to value investing, then index funds, Buffett's style grew increasingly stable. Harnessing compounding, he built a vast investment empire. In reality, those embracing compounding and long-term thinking reap time's rewards, achieving extraordinary results in work and life. After listening to this episode, do you have any new insights on value investing? Feel free to leave your comments and join the discussion. All right, the epic of Buffett and Munger on replicable value investing. That's all for our interpretation of this book. The reading notes are below the audio. See you next time.